This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Chapter 5 looks at the finance function and will include a discussion of the functions of internal audit. As it says here, overall the finance function is responsible for the following. First of all, the recording of accounting operations. How many units have been sold? What have they been sold for? What costs have been incurred? What wages have been paid? And what interest has been paid? And so on. After the information has been recorded, then you're opening the way up to analysing it. What products are most profitable? What products are selling better than last year? What expenses are running ahead of last year? And what branches perhaps are the most profitable? Planning is there. We have to plan maybe the opening of new operations, new stores. It's going to take a certain amount of money to do that. We have to make sure we have the money available to do that. We have to plan to pay our taxes, plan to pay our dividends and the like. Decision making. What products should we keep selling? What should we withdraw? Should we buy a new machine A or new machine B? Should we close down that branch? Should we employ more people? These are all decisions which have to be made and which depend on information very much coming from the finance function. And finally, there is control. We have to keep an eye on expenditure. We have to keep an eye on sales. We have to make sure that cash, if it's received in a shop, is paid in promptly, so it doesn't be subject to risk of being stolen and so on. We have to control the new expenses, new people being paid and so on. Safeguarding the assets is also part of the finance function. The components of the finance function are as we have set out here. If I can find it where we're at, management accounting. Components of the finance function are here. There is financial accounting, and financial accounting is really responsible for producing the financial statements, the organization's financial statements. Financial accounting looks after the recording of cash payments, cash receipts, sales, purchases, wages paid and so on. And at the end of the financial period, it will be producing the financial statements, which is basically the statement of financial position, used to be known as a balance sheet, the statement of profit or loss, sometimes used to be known as a profit and loss account, cash flow statements, notes, and statements of movements on equity. The financial accounts are maintained essentially using a double entry system, which is here. There is the nominal or general ledger, and the nominal or general ledger, this is where you keep account of expenses such as rent, wages, depreciation, interest paid, income from sales and so on. It also records a cash book, the movements on usually movements in and out of the cash account at the bank. There is a receivables ledger, how much your customers owe you. Sometimes it may be called the debtors ledger. The payables ledger, how much do you owe to your suppliers? That may have been called in some cases the creditors ledger. There is the non-current asset register. Non-current assets used to be called fixed assets. We need to keep track of the machinery, the computers, the vehicles and so on, which the business owns and uses. There is the sales day book, where very often the sales are first listed. So this is called a book of prime entry when a sale is made, and you sometimes in our older system certainly you'd enter it into almost a register or a notebook, and then later on from that you could produce invoices and you could record who owes you what into the receivables ledger. And similarly, you had a purchases day book. Again, it means what it says. As you bought things on a day-to-day basis, you would really write a list of the purchases you've made and the invoices you'd received. You capture them in these day books, and then later on you could do the double entry. You could credit the payables, you could debit the expense, and so on, as it went into the proper double entry system. As well as the financial accounting system, there is a management accounting system. And a management accounting system deals not only with transactions which have happened, but also looks very much into the future. Financial accounts is very closely regulated when you produce your annual financial statements, statement of financial position, statement of profit and loss, and so on. These are subject to really very strict accounting rules about how and what you display in these documents. Management accounting is very much a law unto itself. These are internal documents used to help managers make decisions and to control what's happening within the organization. And whereas the financial accounts looks backwards and essentially displays what has been recorded in the past, financial accounting is historical. Management accounting looks back and says, well, this is what this has cost you to make, but also will look forward to budgets and planning and so on. So the typical typical management accounting functions are as shown here. Drafting budgets. Profit and loss account and cash flows are the particularly important ones. You can compare actual results to budget results, and the difference are usually known as variances. So if actual sales are above budgeted sales, people are pretty happy. You'd like to repeat that exercise. That would be called a favourable variance. If actual costs, however, are below budgeted costs, then people get a little worried. You want to try and see if you can control those costs if at all possible. Sometimes you can, sometimes you can't. Sometimes costs have gone up simply because world prices and commodity prices have gone up. But sometimes costs might have gone up because somebody has been careless. Management accounts helps you to work out the cost of units produced. You can record what labour went in, what material went in, what machine time went in, and so on. You can work out the cost of production. And that's important not only to value inventory, but if you don't know the cost of production, how on earth are you going to work out what you should sell those items at to make a profit? You have to sell them at something above cost price if you're going to make that profit. It can also analyse the cost of or the effect of certain decisions. We talked in an earlier lecture about outsourcing. And there's an element of planning and decision making in outsourcing. We need to know if we were to close down our internal IT department and to outsource all IT operations, or perhaps to move our IT department entirely to our Birmingham office to have a shared service centre, what will be the cost of closing down let's say the 12 IT departments and maybe relocating it into Birmingham and redeploying people there and so on. You can't make decisions in a vacuum. You need information, and management accounting is going to provide much of that. The final one we have here is calculating the break-even point of products. This is getting slightly more technical, but it gives you an idea of how many items do we need to sell just to hit zero profit. And this is a very important planning tool. Is it going to be worthwhile making these products at all if we have no hope of making enough of them to bring up, to come up to this break-even point? Ideally, you want to be higher than it, but if you're going to be stuck at making losses, maybe better to spend your money somewhere else, or maybe even better to close down that part of the business. Management accounts are usually prepared and presented to the board once a month. Any less frequently than once a month means really too much has happened before the board finds out about it, and all the decision making, there's going to be far too much of a delay and a lag in it. Financial accounts, on the other hand, financial statements, are usually only produced once a year, as they are required to by law. Treasury Department. Whereas the Financial Accounting Department is found in nearly all organisations, medium-sized and upwards you'd find a Management Accounting Department. Treasury Departments tend to be confined to larger organisations. And they are really concerned with where does the company get its money from, is one of its prime roles. For example, if we're going to be investing in a new factory, where are we going to get the money to spend on that? Are we going to go to our shareholders and ask them to pay in more money to buy more shares, like what would be called a rights issue? Are we going to go to the bank and try and raise maybe a 5-year loan, 10-year loan, something of that sort? Are we going to reduce our dividend? So we've made some profits, but instead of paying it out to our shareholders, we keep that cash in the company and use that to put up the new factory. Sometimes a company, particularly if it's got seasonal fluctuations in its trade, it'll go through periods where it's got surplus cash. It knows that 6 months later it's going to have to spend that cash when sales aren't so high, but Treasury will be looking after where do we park that surplus cash, maybe to earn a bit of interest or a bit of income, whilst it's not needed for anything else. Again, seasonal trading will also often produce a temporary need for finance. And typically what the Treasury Department would do is to arrange an overdraft. An overdraft is normally regarded as a fairly temporary arrangement. You take it out for this 3 months, and then when sales get better, it's repaid in the following 3 months, and so on. Treasury also gets involved in import-export businesses where you have to deal in foreign currency. So if you are exporting you're in Europe, or you're exporting to America, you're going to be getting maybe dollars received, and if the dollar-euro exchange rate varies, then you could be in for a nasty surprise in how much the dollars actually convert to in euros. Of course, you could be in for a pleasant surprise if the dollar got stronger, but it's up to Treasury to manage that uncertainty and to manage that risk. Similarly, interest rate movements. You know you want to borrow in 3 months' time, but what happens if in 3 months' time interest rates have gone up? Is there anything we can do to protect ourselves or to plan in advance to bring again some certainty into interest rate movements which are going to be affecting either borrowings or deposits? And finally, taxation management, perhaps a controversial issue. Many multinational companies have been accused of moving profits around the world so that the profits end up in a country which pays where they have to pay very little tax and so on. But that sort of, we'll call it tax avoidance and tax management, is again part of the Treasury Department's functions. Internal audit. External audit, just to remind you, external audit is an independent firm of accountants who come in and basically examine the financial statements before those financial statements are once a year presented to the shareholders of the company. This, if you remember when we talked about corporate governance, was the original and only form really of corporate governance. Once a year, financial statements were produced, given to the shareholders, and that's how shareholders knew how the directors were getting on. And to give more credibility to these financial statements, the independent auditors would examine these financial statements and hopefully be able to say that they gave a true and fair and unbiased view, if you like. Internal auditors are usually employees of the company. Again, it can be outsourced, but for the purpose of this lecture, we'll assume they are employees of the company. And they are there all the time. It is not their job to look at the financial statements. What they are looking at, they're an independent objective assurance and consulting activity in the hope of adding value and improving the organization's operations. And what it wants particularly to do is to look at risk management, control and the governance processes. Most of internal audit's work, most of the time, is concerned with looking at the organization's system of internal control. If you remember, the system of internal control should be established by the directors. It is part of their function. Corporate governance codes say it is the function or part of the function or responsibility of directors to establish a system of internal control. Something which stops money being spent where it shouldn't. Something which makes sure that assets are safeguarded. Something which makes sure you only send goods to people who are likely to pay you and so on. Something which stops people claiming overtime when they haven't actually performed the overtime. Something which stops people employing far too many people so that the wage bill gets far too high. This is internal control. And the system of internal control has really procedures on how you do things. Very often it's authorization. Before you can hire somebody, you have to get authorization maybe from a director. Before you can claim overtime, you have to get authorization perhaps from your manager. Before a new customer is accepted and you're going to give them some credit, it has to go through some checking and authorization procedure to make sure they're creditworthy. Most of internal audit's time is making sure, first of all, that these internal control procedures are effective, in other words, that have been designed properly, and secondly, that they are operating, that they haven't fallen into kind of disrepair through people being lazy or people trying to get round them for the purpose of convenience. So these internal auditors spend a lot of their time going round the different departments and sections of the business, watching and examining what they're doing to make sure that they are complying with the system of internal control. And if they find that they are not complying with the system of internal control, then reports will be written, and these people are likely to be maybe disciplined. So they're going to be told that you shouldn't be doing it like that. You should be following the procedures as laid down in the Internal Control Procedures Manual. Ideally, they will report their findings to the Audit Committee. So if they find that the internal control isn't working very well, it used to be they would report that to the finance director, but really it was the finance director who had responsibility for establishing this system of internal control, and making sure it was working properly. A bit of an embarrassment if they find out it's not working very well. But if they report to the Audit Committee, an independent body staffed by non-executive directors, it gives much more strength to these people because they can be confident that if it's really serious, the Audit Committee will raise this in a full board meeting and something's going to be done about it. Occasionally, the Audit Department is going to be given special assignments, maybe looking at value for money, maybe doing that exercise we were talking about. If we close down IT in all of the 12 subsidiaries and we centralize IT in the Birmingham office, what kind of changes will this make in both efficiency and expenditure in running our IT department? Should we subcontract logistics perhaps? What sort of value for money are we getting by keeping it internal? Sometimes the special assignments which they are dealing with are fraud. Fraud is the deliberate, generally defined as something like the deliberate misappropriation of assets or the deliberate misreporting of the company's position. You can have errors, of course, and internal audit might find people committing errors, but fraud is the deliberate dishonesty, really. For fraud to occur, you need three things to be in place. You need motivation. In other words, the person committing the fraud needs a reason to do it. It could be just old-fashioned greed, that the employee just helps themselves to cash or helps themselves to inventory. It could be greed which is pushed by desperation, that if I don't pay my rent this month I'm going to be evicted or something of that sort. Within fraud there can also be motivations like revenge. You've just got the sack, and you've got 4 weeks to put in before you finally leave. Well, you may as well get your own back as a form of a motivation. Directors are sometimes particularly motivated because of their pay structure. If you get a large bonus if the company makes big profits, then you could be motivated to overstate the profits that the company is making, so your bonus is bigger than it might otherwise have been. After motivation, you need opportunity. So you might want to steal cash, but only if cash is left lying around will you be able to steal it. You might want to steal inventory, but only if it's badly controlled, and again, not kind of locked away and so on, will you be able to steal it. If thinking about directors, one area which gives the misstatement of profits particular opportunities is if there's a lot of estimates involved. So let's say you're putting up a new block of apartments, and it's going to be maybe 3 years before those apartments are finished. There's a lot of estimation involved in what profit's going to be made in the early years, because a profit is going to be the final selling price less all the costs. But if you're only a third the way through building, there's a lot of estimation involved in what the future costs are going to be, and they can be underestimated to provide an opportunity for overestimating the potential profit. And finally, you need an attitude. Basically, you need a dishonest attitude. We could all be short of money. We could all see cash sitting around within our employer's business, but very few of us will actually go and grab that cash because we're ethical, because we know it's bad, we know it's dishonest. And so we need an attitude, a willingness to undertake dishonest acts. And of course, you have to dare to do it. You have to be willing to undertake the risk that you may be caught. Generally, there are two types of fraud. Theft of company assets like cash or inventory, or laptops, non-current assets could be stolen as well. Or fraudulent financial reporting, where directors or managers overstate profits, perhaps to get themselves bigger bonuses, perhaps to get a bigger selling price for the company if they're thinking of selling to someone, perhaps to increase their share price if it's a listed company. Fraudulent financial reporting, there's motivation from all of those. The directors are responsible for preventing and detecting fraud. Auditors, external auditors, are not responsible for that. If the fraud is very large, external auditors should find it, but it's not primarily something that they are looking for. Once a fraud is discovered, then the company will normally want to find out who is involved, how much money is involved, how long has it been carried on for, how can we stop it. And this is where internal audit tends to become involved. There are certain potential conflicts of interest within the finance role. It's always getting back, remember in the last lecture we talked about the ethical principles, where the things like objectivity and integrity and so on. Accountants working in companies, not just auditors, but actually working in the companies, will find potential conflicts of interest there. For example, accounting operations. You get a repair coming in for a motor vehicle. Okay, if it's replacing a tyre on a motor vehicle, that would normally be a repair. Certainly a puncture repair would be an expense of the business. But what happens if you get an entirely new engine? So at some point you change from saying that expenditure is an expense to saying that expenditure is a non-current asset. The expense reduces profit, the non-current asset doesn't reduce profit, and there might be pressure on you to misallocate some of these types of expenditure, it's just an example of maybe a conflict of interest if coming under a little bit of pressure to try to increase profits. Analysis. You analyze what's going on within a business, and you find there's maybe underperformance in one particular branch. But the manager of that branch comes to you and says, look, the underperformance in this branch, it's maybe all to do with how you've posted or divided up some of the head office costs. Instead of taking some of the head office costs and posting them to me, why don't you move them somewhere else? So we don't get a full picture of why the underperformance has happened. Planning. Directors might want to close down one part of the operations, again by manipulating where costs go and how you make certain accounting entries. You can make it more likely that certain areas of the business are closed down or maybe subcontracted than others. You can manipulate figures, you can move them around a little bit. Even something like setting a very ambitious budget, a budget you know someone's never going to get, and then when they don't get it you can say, well, you're not very good, you didn't get that budget, you're not really lying about the actual results, but you've been in a way telling an untruth about the budget was. You can land that person in a lot of bother by wrong forecasting, by wrong budget setting, which then is really condemning them afterwards when the results come out. Decision making. Directors, particularly directors of listed companies, usually want to produce increasing profits or profits close to what they have forecast. So you might be postponing closing down a factory, or you might accelerate closing down a factory to manipulate the profits. And control. Fraud has been discovered. Finance director really embarrassed about this, wants you to kind of brush it under the carpet, not to make a big fuss about it and so on. Maybe instead of bringing in the police, you pay that person off very quietly so that nobody ever really finds out about the fraud and no embarrassment is caused. As an accountant, you have to think yourself to what extent what you've been asked to do is ethical. Whether it is within what you might call normal accounting operations and normal accounting judgment, or whether you're being pushed further than that, and what's actually being asked of you is something which is verging on dishonest. Finally, just a brief word on current developments in the finance function. The finance function used to be, shall we say, it used to be dull. It used to be very much almost financial accounting, recording what had happened, doing very repetitive type of monthly management accounting and so on. But these writers, Burns and Scarpins, have suggested that this restricted role is changing so that the finance function is there to provide much more evidence, much more information, and to take much more part in the future strategy and decision making of the company. And the three reasons that they thought about this were as follows. First of all, changes in technology. Good IT systems mean that the accounting information, when you have recorded it, can be reported in many ways. You can do all sorts of bar charts, graphs and so on. All sorts of analyses can very quickly be done by the use of spreadsheets and so on here. Just technology makes it far easier, far faster to use this accounting information to find out interesting events, interesting patterns, and then to maybe put it through a kind of cash flow forecast and say, well, if we were to do this, what is the likely outcome to our profit? Changing in the management structure, we talked, I think, earlier on about the very tall, narrow sort of management structures, which is very much people at the top telling the people below what to do. We've moved from tall, narrow much more to a wide, flat sort of an organisation here. And a wide, flat organisation means it tends to be much more devolution. You have to tell people further down the organisation, it's kind of your decision. I haven't got time to make decisions for 10 or 12 of you. You have to get the information and to make the decisions yourself. So the responsibility for budgeting, for hitting budgets, for making decisions which are going to affect results and so on, has moved much more from the centre or the top to individual managers. So the management accountant can focus on strategies for improvement. And finally, competition has got much more hot, much hotter, much tougher. We have to react much more quickly to what our competitors are doing, to new promotions, to new prices, to new products and so on. If a competitor brings out a new product with a new price, we quickly want to find out what it's costing them, what sort of profit do we think they're making. Could we make a competing product, and what sort of profit would we make on that? So there's a very commercial orientation here on the future survival of the company. The following has also, I think, changed the role of management accounting here. Most businesses have become much more international, and apart from anything else, it means much more competition. We have to be on our toes far more often to ward off international competition, or indeed to break into international markets, which will be very important for us. Deregulation and privatization of industries. Again, I said one of the first lectures that it used to be many industries were owned by governments, were very tightly regulated. That's not the case in many countries anymore. Businesses have become privatized and they have a mission to make profits. And if you're going to make profits, you need good management accounting information. New business processes, for example, just-in-time inventory. Instead of having great warehouses full of inventory there just in case, now the idea is to say, well, that's wasting a lot of money keeping that there. We want to organize our business so that as somebody orders a product from us, we order the parts, we kind of make the product to order and so on. And management accountants get very much involved in this, in working out the cost of production, making sure that purchases and so on work very smoothly. We need a need for rapid responses to keep up with new technology, keep up with new products, to keep up with new competition, to keep up with new ways of selling. For example, the internet. 20 years ago, hardly anyone would sell over the internet. Now many people do. And over the internet, people expect many of the products to be cheaper than if you went to a shop and so on. And management accountants have a big role in ensuring that the internet operations are run efficiently. And then there is an increasing importance of non-financial indicators. Financial indicators such as profit, that might be the prime financial indicator, tell you how you've done. Profit is a scorekeeper, but profit doesn't tell you, the profit figure doesn't tell you how you've increased profit. And how you've increased profit might be because you ran a very successful advertising campaign, or maybe it's because you've introduced a new product which people are very fond of, or maybe it's because you offer a very good service to people, and because of this good service people keep coming back to you, or maybe it's because you always have the product in inventory, so people come to you because of this assurance of supply. Whatever it is that gives you the good profits, we ought to measure it. And if it's a good reputation, if it's good quality, if it's always having something in inventory, we have to devise ways of measuring that. And again, management accounting has a part to play in trying to assess non-financial indicators as the drivers of financial success.